Welcome to Iron Financial. We're here to forge stronger portfolios by stress testing the market's biggest assumptions. And today, we're putting Booking Holdings into the forge. After its latest earnings report, this stock is a complete paradox. On one hand, you've got a report so strong it could bend steel. But on the other, you have a stock that's been buckling under market pressure all year long. So today, we're running a full structural analysis to figure out if this is a bedrock opportunity or if it's a facade that's just waiting to collapse. Let's get to work.
And that's really the only question that matters right now, isn't it? The numbers that just dropped are absolutely screaming buy, but for months, the market itself has been screaming sell. So what are we really looking at here? Is this a genuine breakout, a fundamental re-rating of the company? Or is this a classic bull trap, something designed to lure in fresh capital right before the floor gives out? The data and the tape are telling two completely different stories.
Well, the first story is one of pure explosive force. The second those Q4 numbers hit the wire, the stock just ignited. And after hours trading, it rocketed up by more than $120 per share. Now that's the market's knee-jerk reaction. It's what happens when you see a massive beat on both the top and bottom lines. The algorithms fire, the shorts start covering. This is raw, unfiltered, bullish momentum. Okay, but let's just pump the brakes for a second. Before that big after-hours fireworks show, this is the reality of Booking's performance since January 1st. It's been down a brutal 22.7%. While the S&P 500 was just chopping around, Booking was in a virtual freefall. So the real question is, can one fantastic earnings report completely erase months of deep structural doubt from the market? That's the conflict we're here to resolve. And to resolve it, we're going to run it through our standard framework. First, we'll dissect that initial market reaction. Second, we are going to construct the bull case. We're talking the steel beams of this business. Third, we'll go searching for the cracks in that foundation. That's the bear case. Fourth, we're going to apply the stress test, focusing on that big existential threat of AI. And finally, we will deliver our verdict. All right, section one, the market's reaction. Was that $120 surge after hours a legitimate repricing based on new data? Or was it just short-term hype that was destined to evaporate as soon as the opening bell rang? The bull argument here is pretty simple. The numbers were objectively phenomenal. I mean, this wasn't a narrow beat. It was a commanding performance that just blew past what all the analysts were expecting. So the market, which had been pricing in this narrative of fear and macro headwinds, was suddenly forced to confront cold, hard data. That surge represents a powerful, data-driven repricing of near-term expectations, plain and simple. Exactly, which brings us right back to the real problem. Why was it a laggard in the first place? A 22.7% drawdown doesn't just happen in a vacuum. The market has been pricing in a significant, long-term risk for months. The skepticism runs deep, so the question isn't whether the quarter was good, it was great. The real question is whether that single quarter fundamentally addresses the underlying fears that caused the stock to lag so badly in the first place. And that leads us directly into the bull case. Look, if you're going to argue this stock is a buy, you have to prove it's built like a fortress. So we're going to ignore sentiment for a minute. We're just looking at the raw materials, the engineering, the load-bearing walls of this business. And it all starts with the foundation, that Q4 earnings report. Let's start with the cornerstone, earnings per share. The company delivered $48.80. Now, the street's consensus estimate was $48.23. So yeah, it's a solid beat. But the really crucial number is the year-ago comparison, when they posted $41.55. That's a huge expansion in year-over-year profitability. This company isn't just growing, it's a cash machine that is becoming more and more efficient by the day. Okay, now for the top line. Revenue for the quarter clocked in at $6.35 billion. And again, this just crushed the consensus estimate, beating it by nearly 4%. But more importantly, compare that to the year-ago number of $5.47 billion. That is powerful accelerating growth. It tells us that demand for travel and for their platform specifically remains incredibly robust. This is the engine that's driving the entire structure. Now, what's really interesting about this slide is how it visualizes the health of the core operation. Just look at these three columns. The first bar, gross bookings, that's the total dollar value of all travel booked. It surged a massive 16%. The second bar, room nights booked, grew a very solid 8% for the full year. And the third bar, as we just saw, revenue, also up 16%. You see, this isn't lopsided growth. It's a synchronized, powerful expansion across the entire platform. These are the steel beams of a healthy, growing enterprise. Okay, let's zoom out to the full year and really look at the blueprints.
For 2025, revenue hit $26.9 billion, up 13% from the year prior. But the critical line item here is adjusted EBITDA, which is up 20% to $9.9 billion. Hold on, for viewers who aren't in the weeds every day, what exactly is EBITDA telling us here? Good question. Think of adjusted EBITDA as a pure measure of the company's operational profitability, before you factor in things like interest, taxes, and accounting decisions. The key takeaway is that their profitability is growing faster than their revenue. You can see it right there in the margin, which expanded by 193 basis points to nearly 37%. They are literally squeezing more profit from every single dollar of sales. And look at the free cash flow, up 15% to $9.1 billion. This isn't some accounting metric, this is hard cash piling up. This is the sign of an incredibly well-fortified and efficient operation.
And this slide right here brilliantly illustrates what a confident management team does when they have a fortress-like balance sheet. They're not hoarding cash in fear. They are actively reinforcing the structure and rewarding their shareholders. They just hiked the quarterly dividend by 9.4% to $10.50 a share. They bought back $2.1 billion of their own stock in this quarter alone. They still have a war chest of nearly $22 billion authorized for more buybacks. And on top of all that, they announced a 25-for-1 stock split to increase liquidity and accessibility for retail investors. I mean, these are the actions of a management team that truly believes their own stock is undervalued. This is a profound signal of confidence.
Okay, that's a powerful bull case. The fortress looks pretty much impenetrable, but our job here is to play devil's advocate. For a stock to get hammered by over 20% on the year, the market isn't just being irrational, it's seeing serious cracks in the foundation. So let's put on the hard hats and go find them.
So the first crack isn't actually in the company itself, but in its neighborhood. According to Zacks, the internet commerce industry is in the bottom third of all the industries they track. And research consistently shows that the top 50% of industries outperform the bottom 50% by a factor of more than 2 to 1. So what this means is that Booking might be the strongest house on a bad block, but a deteriorating neighborhood is a serious structural headwind that has nothing to do with their own operational excellence. Now this shows a really fascinating contradiction. On the left, we have something called the Altman Z-score. It's a formula that predicts the likelihood of a company going bankrupt. Anything over 3 is considered safe, so Booking's score of 6.41 indicates extremely strong financial health. But now look at the right side. In just the last 3 months, there have been 9 separate insider selling transactions. This begs a very uncomfortable question. If the building is so structurally sound, why are the architects, the people who know the blueprints best, selling off their shares? That's a major red flag the market just can't ignore.
Here's another crack, and this one could impact the growth engine itself. The U.S. domestic leisure market is experiencing what the industry politely calls normalization. What that really means is growth has slammed on the brakes, slowing to under 2%. The company's incredible top-line number is being propped up almost entirely by a massive resurgence in international travel, especially in the Asia-Pacific region and in Europe. The bear case here is simple. How long can that last? Can you build a durable long-term growth story when your home market is cooling this rapidly? It puts an immense amount of pressure on international markets to do all the heavy lifting.
But all of those are just fissures compared to this. This right here is the potential earthquake that the market is truly terrified of: AI disintermediation. The fear is that new, powerful AI agents from giants like Google, Microsoft, or OpenAI could completely bypass online travel agencies like Booking. So instead of going to Booking.com, you'll just tell your AI assistant to plan and book your entire vacation. This isn't just new competition, it is an existential threat to their entire business model. This is the deep foundational fear that has been weighing on this stock all year long.
Okay, so we have the fortress, and we have the cracks, including the potential earthquake. Now for the most important section, the stress test. We're going to apply direct pressure to that AI threat and see how Booking's corporate strategy actually holds up. How is management actively working to patch this vulnerability? First, let's be crystal clear about the technology we're discussing. This isn't about simple chatbots that answer questions. The threat, and frankly the opportunity, is in what's called Agentic AI. These are autonomous systems that don't just find information, they execute complex, multi-step tasks. You don't ask it, what are the best hotels in Paris? You say, book me a 4-star hotel in Paris for next week, near the Louvre, under $400 a night, get me a nonstop flight, and make dinner reservations. This is the technology at the very heart of the entire debate. And this quote from CEO Glenn Fogel on the earnings call is incredibly revealing. This is not the language of a CEO playing defense or hunkering down in a bunker. This is the language of an opportunist. He's explicitly stating that they view AI not as a threat to be weathered, but as a hot iron, a rare opportunity to be seized and molded to their advantage. He sees this technological shift as a moment to be tactical and press their advantage, not retreat.
But talk is cheap, right? Is there any evidence this is actually working, or is it just corporate jargon? Well, this number is the evidence. Some have said that Gen AI is everywhere except for in the P&L. Well, at Booking, it's already in the P&L. They have already leveraged AI to drive down their customer service costs per booking by approximately 10%. Think about that for a second. While their bookings are soaring, their absolute customer service costs are down. This proves they aren't just running experiments. They are deploying AI effectively to improve margins and efficiency right now. This is a tangible, quantifiable return on their AI strategy. And this slide right here gets to the absolute core of the stress test. On the left is the market's fear, the bear case. AI disintermediation, the idea that AI agents will simply replace Booking. But on the right is Booking's reality, their entire strategic pivot, AI orchestration. See, they are not trying to compete with the AI agent. They are building the platform to become the most powerful AI agent specifically for travel. They're betting that their massive proprietary dataset of hotels, flights, and user preferences, combined with their loyalty programs and deep partner networks, gives them an insurmountable moat. Their goal is to own the AI travel agent, not be replaced by it. This brings us to the final verdict. We've examined the market's manic reaction. We've built the bull case fortress, and the skeptic has inspected every single bearish crack. We've put the company's strategy through a rigorous stress test, so it's time to weigh the evidence and determine if Booking Holdings is a solid opportunity or a dangerous trap. So here it is, our final scorecard. On the left, the strengths of the foundation are just undeniable. You have dominant financial performance, aggressive shareholder returns, proven margin expansion, a proactive AI strategy with tangible results, and excellent financial health. But on the right, the cracks are real and you can't just ignore them. The poor year-to-date stock performance shows the market's deep distrust. That insider selling is concerning. It's in a weak sector, the domestic market is cooling, and that existential threat of AI disintermediation still looms over everything. After weighing all the evidence, our verdict is that Booking Holdings represents a heavily fortified opportunity. The strength of the foundation, the immense profitability, the massive cash flows, and the aggressive capital returns provides a huge margin of safety. But more importantly, their proactive strategy to pivot from being an online travel agency to an AI-driven trip orchestrator directly confronts the primary bear case. They are not waiting to be disrupted. They are actively working to become the disruptor.
And I have to concede this point. While the risks are not trivial, the stock's 22.7% decline before earnings suggests the market was pricing in a near worst-case scenario. It was pricing in the earthquake of disintermediation while largely ignoring the seismic retrofitting the company is actively installing. And this has created a potential value dislocation. The market sees the threat, but it seems to be underestimating the fortress's defenses and its plan to turn that threat into its most powerful weapon.
So we'll leave you with this final question. For months, the market has been stress-testing Booking's stock price, and it found cracks. But now, Booking is deploying a powerful strategy to stress-test the market's own fears. The fundamental question going forward is which will prove stronger, the market's fear of disruption or the company's ability to execute its vision of AI orchestration. The answer to that will determine if this is a true long-term foundation for your portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.